excited about. I haven't always done the best of it in my own life, but I know it's one of those things like you should be doing, and I'm excited to kind of share my view on some of these things, and I think it's somewhat crazy that we live in this real estate world where there's a lot of opportunities for us, and we often don't take advantage of it. And interest rates are still pretty low. I can't predict the future of real estate. I tend to be a little bit on the bearish side on the short term, um, not so full of unbridled optimism. But if you buy a property that cash flows for long-term wealth, I don't really foresee rental values going down. And if you're on this call, if you don't mind putting the video on, this way at least it can be a little bit more interactive, because I'm really here to just share with you my perspective, and my perspective may be spot on. It may be colored from my experiences, but I want to give you some nuggets I think can help everybody. So if you don't mind, put your camera on so we could feel like we're in a non-COVID real meeting here. Um, so let me just let me just tell you a little bit about what I did while we're waiting for some people to get on. Is I went and I did a download of multifamily properties, which now tend to be a little bit on the pricey side. Would we all agree? Like,
Yes.
some of these multifamilies are going for numbers that don't really seem to make any logical investor sense. But I do think there still are some cherry picking things that can be done out there if we're not reckless in buying somebody's imploding headache. And I want to employ the reverse of our ideal listing philosophy. And I'm gonna look at you, Glenn, because you're right in the middle here. Like, to get the best execution or the best sale price on a house, what do you have to do, Glenn Baker? Are you froze? All right, I'll turn it over to Julio. To get the best price for your seller, what has to happen?
Well, the numbers have to work out first of all, and you have to have basically a motivated. Well, for your seller, um,
I mean, do
I
they
would.
get do they get more money if it sells quick or if it
Oh
sells?
yeah, yeah, yeah. You have to have more exposure to the market, so you get more money if you sells quick. If you have a lot of buyers out there looking for that product.
Right. So to get more value for your seller, you want it to sell quickly. As a buyer, what might we want to look for?
As a buyer, I would say someone has a price reduction, someone that's now motivated, um, cash flow, location.
So I think I think you hit the nail on the head there, Julio, by saying, like, if somebody is not positioned correctly, right? So if the house should be 400,000, they put it on for 500, it doesn't sell. How many times do we see that house go for 330, right? When they get desperate, they throw their hands up. I just take anything, right? I have no offers. Nobody wants my ugly duckling. Now, for us as a buyer, do you think that might be one of the strategies that we might want to, be intentional about when we're, looking to buy some properties, right?
Correct.
Um, and there's still a lot of properties that are available, even though there's very low inventory. And another thing that we can exploit is right now, according to CNBC, if it's on CNBC, it must be true. There's 2 million licensed realtors in the U.S. Now, I think that there's probably a percentage of them that are inactive, because I heard a number of a little over 1.5 million that are members of NAR. But let's just say that there's 2 million real estate agents and there's less than 1 million listings at the time last week at the end of March. So that means that there were 2 real estate agents for every property for sale. How crazy is that, right? It's not a sustainable business model. And when you get fringe players coming into the market, what do they do? Glenn, what do fringe players that aren't experienced do?
They roll over on their value, so they'll give up commission. They'll market on the cheap or the short.
They'll do a shit job marketing.
Yep.
They won't expose the house correctly. How many times, if you ever look for multifamilies, do you see that there's not even an interior photograph?
Yep.
Right? Now, is that doing the seller justice? Hell no. But is that an opportunity for us if we're willing to, maybe deal with that difficult showing? And I see, hey, Carlo, how are you? You're on mute there. So, Carlo,
how are you, buddy?
I'm good. So Carlo's going to be 2 or 3 meetings into this because Carlo's got some pretty advanced syndication options to getting into real estate as an investment. But this is really, and Carlo, I apologize, it's really like a basic fundamental level. But I just want to walk before we run here. So we're now up to 40, so I'm pretty comfortable. I wish you'd put your cameras on so we could have a little bit more of an engagement here. I am most familiar with the Garden State MLS. So what I did is I did a download, and I'm going to walk you through this, exactly what I did, and then I'm going to spare you some of the boring part of it here. Let's see. Invest. So this is my investor webinar sheet. You guys can all see this, correct? And Dan Brosna, are you mobile or are you at a desk?
I'm at a desk.
All right. So Dan, you got to tell me when people stop dropping like flies here when I start going into the spreadsheet here. You're just gonna yell. You're just gonna yell out.
Yep. All right, we'll do.
So what I did, and I'm going to show you how I did this, but I did a raw export of all the data that was relevant in several counties, and I'll look at the counties I picked. So I did 100, and I know the counties I did. So I'm going to come here. I'm going to go on to GSMS. And at this case, the car came in at high speed, and struck the officer. This too will be reviewed, and they will adapt more time, continue to improve the security. So I'm gonna mute everybody. I hear some background noise. And then you can unmute yourself. Talk. All right. So I'm logged into the MLS. I'm going to go to search. I'm going to go to advanced, multifamily. I'm going to pick my counties. For Garden State MLS, Union, Morris, Somerset, Passaic, Essex, and Sussex I'll pick. So you get to pick up to 6 counties in the way the MLS works here. Status, I'm only going to do, for this purpose, I'm only going to do active. And then for towns, I love this, not option. So I'm going to do some of the areas that I personally am not comfortable because I just don't understand them well enough. So take out Elizabeth is an area that's complex. Patterson is a little bit on the complex side. And, Newark. So East Orange. Like some of these more urban areas, I don't understand. If you go different from street to street, they change. And I just don't have the bandwidth to understand that. I think if you understand those areas, you can exploit things, but I just don't have that knowledge on where to be. So I'm going to search all these multifamilies. There's 290 records. Now, has anybody ever gone through and tried to look through multifamilies and it gets to be like really frustrating going through one by one? Because that's what I used to do. What I do now is I'll just take off all the in-attorney reviews because in all likelihood, they're not going to be available when it comes time for us to take a look or to give it really good consideration. So this is the actual process that I did. Not that painful. All right. So anyway, so I don't want to waste your time, but you go here and then you go and you do download and you do an Excel file and you hit download. Okay. Now, if you have video on, have you ever downloaded the data like this before? If you have, give me a thumbs up in your MLS. If you haven't done it, raise your hand. You've never downloaded the data. All right. Hyun, have you ever downloaded the data? Yes or no? All right. So when you download this data, it is a game changer in my mind. Okay. You get to this point here. This is the raw download. Okay. You had no idea that there's this many fields. Look at this. All of that data. That's a lot of data. So that went through the alphabet, A, B, C, D, E, F, G. It went through the alphabet 8 times. That's how many columns there are. So what I did is I highlighted in green the columns that were most important to me, which was the rental income. And a lot of the times the agents don't even put the rental income in. They put that 999 or they leave it blank. So those are a little bit harder to evaluate, but I did that. I eliminated a lot of the columns and I went and set it up with available status, MLS, property, street, number and name, list price. This here is the Rob score.
Sorry, I didn't quite catch that. Could you please?
Oops. So this is the score that I came up with by looking at some parameters to try to look at all the data components together. So I had list price, this score we're going to go into. This is the gross rent. This is the net income. This is the cap rate. Is Carlo still with us?
Yeah, I'm here.
So Carlo, how important is cap rate in your world?
Cap rate, the capitalization rate of a property is, it is really a risk-adjusted return for this specific point in time. and that's why cap rates are subjective. It's subjective to the time, the type of property, the location of the property. So it's a pretty good indicator of where you're going to be. Now, obviously, well, it's an inverted relationship. The cap rate percentage and the net operating income, you actually divide it to to get the capitalized value. So actually, the lower the percentage, i.e., lower the risk, the higher the value. So when you're looking at multifamily, you look at multifamily in New Jersey. I mean, the cap rates are extraordinarily compressed because it is so sought after. I mean, you can't keep it. If you can get it, hold on to it, because it's not trading right now. It's not trading at all.
Right.
So, so your rates. So even if I'm seeing rates, even if you're in, and Rob, you'd mentioned Newark before, okay? If you're in Newark or Patterson, I'm looking at deals that, if you're seeing things in Newark at 7%, at 7 caps and 7 and change, that's not odd. And these are in kind of, they're in a little challenged area, economically challenged areas. But doesn't.
So Carlo, what is included in the cap, like in the calculation of the cap rate, if it's done correctly in your mind? And I'm going to tell you what my opinion of it is, and you tell me if I'm correct from the legitimate commercial side. So if I was looking at it, I'm looking at it as a passive investment. I'm taking there's a gross rent of $40,000. Taxes are $8,000. Let's just say I use a 2.5% vacancy, which would be actually, let's say I do 5%, or no, 2.5 would be $1,000. Subtract $1,000. There's utilities. Let's say it's $2,000. You have repairs and maintenance of $2,000, which would be like an average. And then do some of them put in an allowance for upgrades?
Yeah. Well, don't forget insurance also.
Okay.
Don't forget insurance. And what you're talking about, you're doing a capital reserve.
Right.
You're
So
doing a
capital
capital
reserve.
reserve. You're doing a capital reserve, which you can do, and it's really it'll guide anywhere between 2% to 6%, call it, depending on what you're really looking for.
So let's just do, so we'll do 5% as a reserve. And that would be like an equivalent to like depreciation, right? Because you're looking at the reserve is to replenish things that age out over time,
Yes.
right?
Yes.
So if we looked at an example, and I'm going to put this together for you, where a property was bringing in $40,000 in revenue, okay? There was $8,000 in taxes. There was a 2.5% vacancy. I see a lot of people don't use any vacancy number in there. There's always has to be some, so I'd put a 2.5 in there. You got to take a look at what utilities are, repairs and maintenance, insurance, and a reserve. So this is 2, 4, 6, 8, the $16,000 off of 40. That gives us a $24,000 net cash flow. Okay. And let's say that this property is on the market for $400,000. Okay. To get the cap rate, and Carlo, you correct me if I'm wrong. So
You're at about 6 and you're at about a 6 and change cap, right?
You're exactly 6. That would be a 6% cap rate. Is that good or bad, Carlo?
6 is okay. 6 is pretty standard right now. It's a pretty standard number in today's market. It's pretty average. Let's put it this way: we're seeing Class A multi in the high 4s. So if that gives you any indication.
So one of the caveats that I'm going to put in the show notes here is you need to be careful of deferred maintenance, because that can be a real big disruptor to your income stream on the negative side. And on the opportunity side, you're going to look for what I'd call stale properties. And stale properties tend to be ones that are listed with, you know, less than ideal agents. Okay. And you're going to look for under market rent, because I do see, at least in the resi side, Carlo, I see a lot of landlords that have held on to properties for years and they really haven't adjusted the rents because they don't want to have the turnover. Do you see that in some of the, you know, like 8+ units, or are those more professionally managed and handled better, Carlo?
Yeah, when you're looking at larger assets, unless there's rent control in there, unless you have to deal with rent control, most of them, especially if they have property managers, are keeping up with the rent. Sometimes a little too aggressively, but rent control is another story. But there's something else, and to your point, and I was actually having. Give me a second. I was actually had a meeting with an asset planner for retirees yesterday, and we were talking about this. And what's happening is, you have people who've either had the property in their family or inherited it and really don't know what to do with it, and they don't really want to rock the boat. They don't want to do anything. Grandpa did it this way or dad did it this way, and it doesn't necessarily mean it was the right way. It was just the way they did it, and that's all that they know. And we have clients like this. So you have to go in and you take a look at those, and those are the opportunities where perhaps you're going in and you're redoing a kitchen. You're putting $15,000 to put in a kitchen, but you're going to add $500 a month.
Right.
That makes all the difference in the world.
2.5, 3-year return on your capital. So, if it was an exact science, then there wouldn't be as much opportunities as there are, and it does look a little bit like work. I want to introduce Tom for just a minute here, because Tom's a numbers guy, and he's somebody that has helped some of our team members put together some pretty aggressive financing packages for investment properties. Now, typically, unless you're a first-time buyer and you're planning on having your second home be your real home, you need to buy it with a little bit more money down than FHA. And FHA's got some pretty strict criteria. And being in the profession, we don't want to be involved with anything that could be construed as bank fraud. So there's the right way, there's the wrong way to do things. The right way to do things is to have a well thought out plan. So if you're some of our younger members that never bought a home or don't currently own a primary residence, buying a multifamily with an FHA might be an excellent way to get into the investment field. But if you're already a homeowner, you have to look at a different strategy. So Tom, if you want to talk just a couple of minutes, because I know you have to leave right around 10.
I appreciate it, Rob. I have a few minutes. I also want to give a couple of tips to everybody. There's a great cap rate calculator that I use called Omni. So if you just go on Google and you search cap rate calculator, I think Carlo nailed it. I think most properties today, we're looking at around 4%, just the way that the numbers work. But I also use a larger vacancy factor. I know that you said 2%. When I do my numbers, Rob, I normally do 10 to 15% depending upon market conditions. But it's a great calculator. I love it. You put in the value, you put in the income, you put in the expenses, and it'll tell you exactly what that cap rate is. So this is a topic that I'm really excited to talk about for a couple of areas. This is the realtor loan, as I call it, because the realtors usually find the deals, and in a lot of cases, some do it themselves and some don't, and a lot of them can, and start building that portfolio. So let me start by just sharing with, there are two methods when I do an evaluation for a realtor to see whether or not and how we're going to structure and how they can buy some of these properties. So the first thing I'm going to talk about is income. If I'm doing a typical Fannie Mae loan, we have to qualify all income. And the problem is sometimes when I'm dealing with realtors and with the creative accounting, a lot of the accountant is going to write off a lot of the commissions that the realtors make. So even if I'm using the cash flow and I can use the projected rents on the property, it depends. It's a case-by-case basis whether or not that property is going to have enough income for me to get an approval for a real. So let me just start by talking about down payments. If someone's buying a 1-unit property, you can get a Fannie Mae loan with 15% down. If they're buying 2 to 4 units, you've got to put 25% down. On a 1-unit, however, there is a property, and you may want to search this online, but Fannie Mae has a loan called a home style loan, which not only gives you money to buy the property as an investor, it also gives you money to fix it up. Now, since COVID, I will tell you that my bank, the one lender that I was selling these loans to, put a hiatus on home style, but there are banks that are still doing them. I know that typically if someone went to Wells Fargo, potentially you could get a home style investor loan. And what I like about the home style is you could buy that with 15% down and get all the repairs for your investment, but that's only on a single family and that's fully documented. Let me flip now to the non-traditional financing because that's what I do. And that's what 95% of the realtors who are on this webinar are going to fall into. We would do this as a normal commercial loan. And I am going to recommend for liability purposes that each of you do go out and get a separate LLC on each one of these properties that you're buying. Because it's non-traditional, you would have to put down 25%. But what's really good about this loan is we don't care about your income as a realtor. We only care about 2 things, your credit and if the property cash flows. And generally, if I just want to give you generic terms on, and this is anything from a 1 to 4 family, I'm not talking about any commercial or any mixed use, but on a 1 to 4 family home, when you put down the 25%, generally your rates are going to be in the low 4s on a commercial loan. I may be able to get it to high 3s in a perfect case, especially if it's a single family. But once you start getting to 2 to 4 family, you're looking at more of low 4s rather than high 3s. The other thing, and I know Rob is stressing building long-term wealth strategy and using the rental income to do that. That's what I do every day. But I also have, in certain cases, money for you for bridge loans. I'm very big with it. So if you wanted to use some of the equity in the home that you currently own, because that's another problem. All right, I have one of the properties on the list that Rob gave me, but I can't get it for $400,000. I got to put down 25%. I don't have $100,000 cash. Well, the great news is I can get you the $100,000 out of your existing property in the form of a home equity loan or a bridge loan. Take that money, invest it in the other property. And again, I'm doing that without looking at your income. So I have a lot of creative financing to do this. And before you go back to the topic of holding for rental income, Rob, I also just want to stress some of these fix and flips because I have a whole bunch of bridge loans out there currently myself that I lend money where I'll not only give you money to buy the house, I'll give you money to fix it up and flip it. And a lot of times if you're dealing with foreclosures, and listen, Rob, your timing is perfect because all of my friends in politics and government and police are all telling me that at least in New Jersey, I got to figure out Florida too, but at least in New Jersey, the floodgates for foreclosures are going to open up in September. You're going to see so many of these properties available because while everybody's in a forbearance or stalling on a Chapter 13, that crap's going to hit the fan really hard. And I know because I see every person I deal with on the lending side of how many people right now are not making mortgage payments. And eventually those properties are going to come out. You might as well try to buy some of these yourself. So the fix and flip loan, if you put down 25% on the property, I'll give you 100% of the rehab money as long as we're doing our draw schedule and the final value is not over 75.
So Tom, I want to take that on another day because I know we can go way over here, and I just want to ask you two questions, and maybe you don't know if it's doable or not. I'm going to put you on the spot, but I've been watching a lot of not salesy get rich quick schemes, but I've been watching some pretty credible thought leaders, and I learned something on my YouTube MBA or PhD that I'm getting where I was told that if you get DU underwrite, you can get up to 10 Fannie Freddie loans. Is that correct?
Yeah, so some of our investors are a little different, Rob. Most of them are really at 6 properties, not 10.
Right.
And the only reason I'm saying that to you is because, again, now there's two thought process of this. You have a realtor on this webinar, and those realtors have investors, okay? So if the person's financials are strong, yes, I'm going to forward them to Fannie, and then I'm stuck at 10. However, when I do this under the commercial financing, and most of these people on this call is going to be a separate LLC for each unit. We don't care if they have 100 units. So that kind of takes that thought process out of this.
Second question, because I know you have a hard stop, and if you could stay, that's great. But can you look in to see if Fannie is allowed to exercise the due on sale clause if you're transferring it to your own LLC?
I will check that out. That's more of a legal question for John Skura, but I'll check with him today. And don't forget, a lot of due on sale clauses have changed post-COVID, so we have to find out what that new regulation is.
Okay, yeah, because one of the concepts, Dan, you have a question?
Nope, I was just
Okay.
waiting.
All right, so one of the concepts that I had, and it could be a stupid idea, it could be a great idea, which would be if we get into a little bit down the road here, how do we pull these resources together to do this? Using a conventional, product to buy some properties. And here was my thought process is, let's just say 5 people wanted to get together and buy the first property. Some real estate agents have good accountants and they don't show any income, right? So you might not be able to qualify, but let's just say that, Bob Smith, who's on this call here, who's no real Bob Smith, he shows a lot of income, he could qualify. If we had Bob Smith, buy the property with a group of people as an investment. So let's say that there's 5 people. There's Bob, Dan, Glenn, Angelique, and Lawrence. They buy the property together as an investment. Bob's the only one that signs the note. Bob gets a guarantee fee for signing that note. Let's call it 1%. So maybe that's $300 a month. And then you take advantage of a traditional loan. Bob does have the risk if the asset doesn't perform, but everybody else is part of that ownership group. So this way, you don't have to save up on a $500,000 house. You don't need to save $125,000. You can get in on the game with $25,000 a year, and we have these limited liability partnerships on properties that cash flow. What's your thought? What say you, Tom, on that concept? We hadn't discussed this.
Listen, I love it. It's more buying power with more people, and it's always better to use other people's money. But as a group, we become very strong. And if you think about it with an LLC, we're just buying shares of the corporation. So that shares could be sold to anybody, and it gives us more leverage and more buying power. And if you're, as a group, and the one thing I do like with dealing with different people is there are a lot of people on this call that know their market share. The biggest challenge or the risk involved is not knowing your market. And you guys know your market and know what we could rent, what we could sell, what we can do. You mentioned earlier what I loved what you did when you were doing the NMLS. You took out certain sections because you don't know it. let me tell you, there are certain parts of Newark that I know really well that from one side of the street to the other, literally, I'm going to double my rental. If I don't know that as an investor, that's going to make me very nervous. But the realtors know that. They're the perfect partner to be involved in this. I'm all for it, Rob.
I have 27 minutes. I can't go over because I have a 10:30 meeting, but I'm really super passionate about what we're talking about here.
Rob?
Yeah.
Rob, if I could just 2 seconds. What you were talking about was it's done when you're doing any sort of development or redevelopment. It's basically somebody who's guaranteeing the GMP on a construction loan. So that is done. That concept is done constantly. They will just get they're guaranteeing the loan, but they're going to get an additional percentage, and there's going to be a reserve in case that thing starts to go bad to pay that back.
So Carlo, that's why I have you here. We're in first grade here, and you've got your master's degree. But one of the things that Carlo and I were talking about is ways that we should be getting involved into the hard asset real estate business. And I'm going to go through the numbers on a broader scale. And for the 15 of us that are having your camera on, who is hesitant to get into real estate because you don't want to have to go to court and evict a tenant, or you don't have to deal with a toilet that's clogged? Who's like staying away from it because of those things? Be honest. So none of you are staying away because you don't want to have to get a call for a toilet clog or a tenant not paying the rent and all that stuff. Wow, you guys are brave. But I, for one, I'm like super busy, and like for me, I don't want to have to deal with that because I know I wouldn't be effective because my passion is helping you guys grow your business. But if you have properties that that cash flow properly, you have money to pay for a professional management fee. As a matter of fact, that should probably be included into the cap rate too, Carlo, right? A management fee?
Yeah. I mean, we could have, in that
Well, it was like
underwriting.
10%. Am I wrong? It's usually like 10%
No.
for management fee. No. What is the like percentage that when you look at like the income?
You're maximizing 5%.
5%. Okay.
Generally about 5%.
So some of these like onesies and twosies, Carlo, they get 8 to 10%, like for somebody moved out of their place and doing a single condo. But I think, Ellen, that's because there's no scale, right? Like there's a difference between a realtor with a license managing a property and then a professional management company that has scale. So for purposes of this, I just want to continue to move on. Let's just say maybe we should have thrown in a 5% management fee so that this thing is all buttoned up. But at the end of the day, one of the biggest pieces to this, and I see Michael Clater on there because Michael is familiar with investment real estate, is it's not about just that cash flow, but over time, real estate always goes up, right? I mean, there might be short-term dips, but if we're in this for a 15-year period, right? And now with the government, printing out money like crazy, I, for one, think there's going to be inflation. Okay, that means hard assets are going to be going up. So we want to be in the hard asset business here. So if we're able to get a property that can cover its debt service, right, and it has let's say it's a 5% or a 6% cap rate. Let's just say it's a 5%, and we're borrowing money from Tom at 4%. So we have a 1% margin, right? But what will property be doing in the short, intermediate, and long term? Probably going up at least 3%, maybe as much as 5 or 6% per year, right? So that's exponentially growing your cap rate, right? I mean, your return, not your cap rate, it's growing it because you have this implied savings, okay? To give you an employee mentality, if you were employed by, I'm trying to think, if you were employed by Microsoft, right, and they said, hey, Dennis, we're going to give you a 401k match, right? If you put away, 5% of your money, we're going to match it with 5%, right? Dennis, would that influence your decision to put money away for retirement?
Yeah, I mean, because if they're going to help match it and increase it to 10%, it's not strictly all my money, it's part of the company's money.
Right. And inflation or asset appreciation is like this secret return that we get when we invest in real estate, because it generally goes up, right? The trend of real estate is appreciating. So if we're looking at it at stagnant, and I'm going to call on somebody else here. Carly, what do you think happens to rent over time? In 10 years from now, the rent in your neighborhood is going to be higher or lower?
It's going to go up.
It's going to go up, right? There's no doubt. Rent is going to go up. Asset values are going to go up. If you take a fixed rate from Tom, your payments are fixed, right? So your income is going up, your asset value is going up, and your payments are staying the same, right? So if we get in there at a small margin, folks, and we have a long-term perspective, I don't see how we can not seriously consider this as part of our retirement and wealth building resource here. That makes sense? Yes. Okay, great. So I'm going to go into my spreadsheet once again, and we're going to test it out a little bit. So we have cash flow, and you might want to write this down, and then I'm gonna put it in my notes. It'll probably be out to you by Thursday or Friday. It won't be out today. It's going to be cash flow. You have debt reduction and appreciation, right? And if you wanted to get technical, you get to depreciate you get to shelter some of the income, right? And pay it hopefully in the future as capital gains, right? So we have cash flow, we have debt reduction, we have property appreciation, and we have a tax advantage called depreciation. So all these things are all saying that, real estate's a place where we should be, right? Does anybody have any comments on those like 4 elements of real estate? So if you can hold on to your real estate for a long time, Michael, what eventually happens to it? Michael Clater. The mortgage goes to a round number, right? Let me see if I can unmute you, Mike. Here, I unmuted you, Michael. Over time, what happens? Your mortgage balance goes up or down if you manage your finances right?
The mortgage balance goes down, and so you're gonna get the zero. So that's kind of the key. Then you're 100%. You're cash flowing very strongly.
So if we put down $125,000 and let's just say we paid that property off in 15 years or 20 years, right? In 15 or 20 years, our debt service is zero. Okay. All we have is our operating expenses. Like this thing's cash flowing like a monster. And what you're probably looking at doing is buying a few more, right?
Yeah. Well, absolutely.
So, and in our business, you get that, that 401k match, Michael? I call it a commission. Like you get a 401k match when you buy a property because you get a commission on your own deal, right?
Exactly right.
So this is like a perfect storm for us here if we can just figure out the strategy. Now I think one of the challenges for us as an industry is the way that we get paid. If you work for Microsoft, Michael, and you made $10,000 a month, how much do you think gets deposited into your bank account, every half a month? So let's say 5,000 every 2 weeks is your gross pay. What do you think is going into your account?
Probably about 3,500.
Maybe even less than that, right? Maybe 3,000, right?
Right. Exactly.
So you can't spend what you don't have as an employee, can you?
That's correct.
So you have to figure out how to pay your bills by doing that. One of the things that I'm suggesting, and when you do a 401k, the reason why people, I think, do it more consistently is they don't see it, right? It's not like they pay you and then you write a check back to the 401k. They just take it out of your pay and they deposit it in that special lockbox account. So for us, part of the foundation, I think, before we get hot and heavy about finding a property, is figuring out how to allocate those resources if we haven't been a great saver. And I'm thinking for most of us, we should be identifying right around now when we pay our taxes, like how much of our income do we need to put aside for Uncle Sam and Governor Murphy, right? How much money do we need to exist and pay based on our income? And for you guys in Florida, that would be DeSantis, okay? Well, actually, you don't have any state income tax, so excuse me. The second piece is, how much money are we going to be able to earmark for retirement and investing? Okay, some of you on this call, the first step might be just to make sure that you put away enough money for your taxes so you don't freak out at certain times of the year when your quarterlies are due. The second step is, maybe you want to start to put some money into a retirement account, or you might want to put some money into an investment account, or maybe your investment account is your retirement account, your real estate investment account. Because I'm not the expert to do that, but you can buy real estate in a retirement account, right, Carlo?
Yep, we're doing it right now.
So we have the resources here to guide you. Now it becomes willpower, right? It becomes discipline. So, whatever you're making, if you took 20%, if you're on the lower end, it's probably enough for taxes. If you're a high earner, you might want to put 35% into a tax account so that when taxes come due, you don't even need to think about it, right? And the next step.
Well, why wouldn't you want to just put that into a 401k when you can reduce your taxable income by like 56,000, I think, right? First.
So, but you can't
pay yourself first.
I mean, you can't reduce it all, but I mean, those are things, Ellen, that are individual, and that's smart to try to defer your taxes by putting it away. But you might even be able to structure it with Carlos' concept, and I'm not going into it, by investing into real estate as a 401k vehicle and deferring it from your tax.
You can hold it in IRA too.
Yeah, that's exactly, hey, Rob, that what Ellen is saying is exactly what I'm saying. Basically you could put it into your self-directed IRA, and then you're taking it out and just investing it. I mean, and I'm helping people do that as we speak. So
holding real estate within your IRA, Carlo, right?
Absolutely. That's the beauty of that is the beauty of having a self-directed IRA.
Are you
so basically, is it shares? You're holding shares of the LLC within your IRA that is like representative? Okay.
Correct.
Carlo, are you allowed to take debt on an IRA property or no?
Well, what you're doing is you're taking that. You can borrow against your IRA, but what you're doing is you're taking that IRA and you were taking that, and then you are just investing that in the LLC.
So if you bought a property by yourself, a single entity
single
property,
purpose.
Right. So it was 1010 Main Street, right, LLC, right. And I paid $500 for it. And I put $125 down. Am I able to sign a mortgage for a property that's getting contributed to the?
Absolutely.
So that's huge. So
absolutely.
This is a little bit.
Then wouldn't the income also from that LLC go back right into the IRA as well, and you can defer it?
It can. You can do that. You can guide where your checks are going.
Okay, so I'm getting some comments here about the tax vehicles that we're doing, and I'm not the tax expert, but this is like 101 here, and if there's 50 people, if there's 7 people that want to do this and you want me to help, you got my full attention and commitment, because I really care about helping put some money aside and doing it now, not doing it 10 years from now, because it will make a world of difference if we can do it sooner. And it's not about me, it's about giving you guys the information to make the right decisions. So the next step I wanted to talk about here is going back to this sheet in terms of how do we identify the properties. So what I did, and Carl, this is not to your pay grade here, but I took all the properties here, and the ones that had income on them, I took the gross and the net, and I took I labeled them in the highest and lowest return on gross income to purchase price or to ask price. Then I did net income to ask price, and I ranked them. So ask price, excuse me, I had cost to gross. I had cost to net return. I had your ask price to the assessed value, and I had it done by the cap rate. So I created 5 random categories, or was it 4 random categories? I totaled them up, and then I took all the properties here, which was 200 and some of them, and I went from 100 down to 60. So I gave the best property a score of 100. I went down to 60, and then I added up all the scores. So if my algorithm, which is a self-written algorithm here to look at several hundred properties, is right, these 10 properties here from 2 to 11 should be some of the most interesting properties for us to look at. Like here's this one, River Road. Just take a look at it.
You are recording this because you lost me like 10 minutes ago with this whole thing. I got to look at it like slowly.
It is recorded. Yep. I hope it is. I'm sure it is. So if we go and put this MLS number in here, let's take a look and see if this property is better than average. Here we go. Oh, that's not the right one. So I'm going to take this MLS number, I'm going to paste it into Garden State. And this is a property in Passaic. It's actually looks like it's a 4-family. Looks like it was renovated. I don't know how it wound up here without did it have the gross rental income? Yeah, I don't know how it made it up here, but so this property here is a 4-family. It's a bad example without the rental income. It must have been put there because of its position to the assessment. Let's take a look at Humphrey. So this one's in Clinton Township. This one's a 3-family. There's the rental income. The taxes are reasonably low. Price is reasonably low. The calculation for the assessment versus the purchase price is really not a very good one because all different towns have different tax assessment rates. But a total return of 35.5 on a property for 399.9. Carl, that's pretty decent, right? If these numbers are legit.
Yeah.
So after expenses, 35,000 divided by 399 is probably what, about a 7.5%, 8.5% return?
Unlevered.
Unlevered, yeah. So this property here would probably be something worth looking at. I don't know if this is looks like it may have some commercial components, or it might just be residential. You might be able to buy it with a regular 15 or 30-year fixed rate loan. But if I'm going to run through these numbers with you here on this, I'm going to do it really quickly. So if we paid full price on it, We took the commission, offset our down payment, or used it towards closing costs. We have $400,000. We have a $300,000 mortgage. For an investment property, Tom's gone, right? Any lenders on? Present value, 30-year. Let's just say it's 3.5 because the rate's going to be a little higher on an investment property. That's $1,347 in principal and interest on a 30-year. And if we did this on a 15-year, we'd probably get it down to 3%. And on a 15-year, it's 2,071. And 179. And the first payment on a 15-year is $1,322 of principal. So our cost is $2,071 minus $1,322. Our interest expense here is $749. Our taxes are $8,400. That's $700 a month. Let's say insurance is $250. Let's say maintenance is $250 a month, and let's say utilities are $200 a month. So that's 5, 7, 14. That's $22.49 a month. And if it's bringing in 44,000, let's call it 44.9. So that's 45,000 divided by 12. That's 3,750. And its cost to us is $22.49. And our profit is $1,501. I take the principal of $1,322. Our cash flow is $181 a month. And we have this thing paid off in 15 years. Does anybody think that this would be something that might be a good investment? Anybody?
Yes, absolutely.
Bueller. So tell me your thoughts. Glenn, what do you think?
Yeah, I mean, people get so hung up on what the monthly churn is opposed to building equity in it that, it's entertainable. It's a little bit narrower margin than I would prefer, but entertainable.
But if you did a 15-year, you'd probably have, or excuse me, a 30-year, you'd have about a $700 positive cash flow.
Yeah.
So what I'm saying is, if we go through, and I think that individually, yeah, we could all do onesies or twosies, but I think as a group, we have a collective power, and in terms of putting this together, and in terms of like the compound effect, I only have 4 minutes left, but if you put your money in some place where you get a 5% return versus a 20% return, okay, because your return also includes the appreciation here. In 10 years, I'm actually going to do a 15-year. Let's say we paid this thing off in 15 years. If you found an asset, which is probably hard to do right now, which is giving you a 5% return, 05, enter 15. So if you had a 5% return for 15 years, right? So you put in $100,000, 5% return in 15 years. What do you think that's worth? Anybody?
$100,000, 5% return.
Yeah. What's the appreciation, or what's the total value of that account?
What, 175?
208.
208.
So if you had a 20% return, which you would have a better than a 20% return here in 15 years, that will be $1.54 million.
Can I just?
That's the compound effect. Yes.
Can I just add something to this before we go? You know, this is obviously this is stuff that we do. I mean, Rob, you know this is stuff that we do. The best thing when you have a group of investors going in and you have 10, 20, 30 investors, and what you're doing, you have the ability to mitigate the risk. A, mitigate your own risk, but second, you as call it investors and asset managers, you could take a look and you can spread the risk out on what you're going to invest in. So sometimes you don't necessarily have to take a 100% position buying a multifamily property. Maybe you take a 10% position or a 15% position. Maybe you're doing it that way. And then things that have a little more upside in it, you'll take a bigger position in. So you're hedging your investments there. But the fact in doing it as a group just gives you that much more money to work with to get there that much quicker.
So I'm gonna, if you're still interested, I'm gonna take this up next week. I'm gonna take it from here and bring it out. I'll have the show notes out by next Friday, or excuse me, by this coming Friday. And if you guys have any questions, like I'm a bit of a nerd. I actually have an HP 12C, which is like a standard issue mortgage calculator here, which tells me, you know, how compound returns work, how much principal is paid the first payment on your 15-year, 30-year mortgage, okay, and no strings attached. You know, I just want to see us as an industry invest more in what we sell. So if you have any questions, I'm going to try to make it easy for you to do the analysis. I'm going to share with you the spreadsheet. I'm going to give you guys this recording, and I'm inviting everybody back next Tuesday at 9:30 if you want to take it to the next level. And then after next Tuesday's meeting, maybe we can talk about if people want to invest together. But I think the simple step is, look at, if you want to just take, maybe it's 5% of your commissions, you know, open up a separate bank account at the same bank you're at and have that money go in there. And then at a certain point in time, you'll have enough money to make your first fractional investment or maybe complete investment. But I really, really know how hard everybody works here. And I have a passion to see that we retire wealthy. Okay. We don't just live a life where we earn a big income, and at the end of it, we still need to work. All right. It's 10:30. I appreciate it. I hope, did you guys find some value in this? All right. So I will see you. If you do, same link for next week. Okay.
Thank you, Rob.
All right. My pleasure. Bye,
Thank you.
everyone.
Thank you very much.
Thank you. Bye.